Hey guys, today I want to talk to you a little bit about refinancing. A refinance is when you replace your current mortgage with a new mortgage that has more favorable terms, and there are two different types of refinances. The first type of refinance is a rate and term refinance. We saw a lot of this in 2020 and 2021 due to the historic rates, which got as low as the high 2% on a 30-year fixed mortgage. The benefits of a rate and term is to reduce your interest rate, lower your payment, change the loan term, or switch the loan type, meaning going from FHA to conventional to eliminate the mortgage insurance. The second type of refinance is a cash-out refinance. Cash-out refinance allows homeowners to turn the equity in their home into cash. This type of refinance is the more popular of the two due to all the equity that has been gained over the last couple years due to appreciation. We've actually seen some homeowners gain as much as 40% just in 2021 alone. The benefits of a cash-out refinance is that you get to use those funds for pretty much any purpose. So rather that's paying off debts, doing the home improvements or renovations you've been looking to do, or any large transactions that you have planned in the near future. You don't need a specific purpose for the funds. You can even put them towards things like an emergency fund or any other investments. So you may ask, how do you qualify for a rate and term or a cash out refinance? Number one, ideally you would like to have a credit score above 620 so you can qualify for a conventional loan. But in some situations we can get you qualified as low as 505 on an FHA loan. Number two, home equity. On a rate and term refinance, you can go all the way up to 97% and qualify. But ideally, you would like to get that number below 80% of the loan to value to eliminate any mortgage insurance that would be involved in the monthly payment. For a cash out refinance, it's a little different. You can turn your equity into cash up to 80% of the loan to value. So for example, if you have a home that's worth $500,000 and your current mortgage is at $200,000, you can take that mortgage up to $400,000, giving you access to $200,000 cash in hand. Number three is your debt to income ratio. Ideally, you would like to keep your total monthly expenses below 50% of your total gross monthly income. And number four, closing cost. A common question I get is, what about the closing costs? Do I have to pay that out of pocket? And that answer is no. Typically, you can have the third-party closing costs rolled into the loan, so you're not paying that out of pocket. And you can even ask your loan officer about some options to get credit from the bank to go towards the third-party closing cost. My name is Kevin Soth at Purpose Funding, and another great option for pulling cash out without having to touch your first mortgage is a HELOC or home equity loan. Check out this video right here to learn more.